We're going to look at some Dropbox updates, a couple of Fibonacci levels. We're going to take a small break, 5-10 minutes, if you guys permit that to happen. Then we're going to look at a little bit of risk reward, and then talk about some future meetings that we want to get ourselves involved with later on, maybe next week or the week after that. All right, the first thing we're going to talk about is the Dropbox issues that we had last week. This week, we're going to carry 2 folders. We obviously carried the blue group and the gold group. Last week, they were called the blue sheet and the gold sheet. And the gold sheet is revolving around our basket traders, which is primarily all of you guys. But some of the folks that run with us and they just trade the weekly stuff that we do in and day out, they're running on the blue group. But because you guys are the majority of the basket traders, you have to have access to the blue sheet also. So we're going to change the name of the blue sheet to the blue group because we had an issue late last week with a corrupt file on the other end. It wasn't from our end, and it doesn't matter whose end it came from. The fact of the matter is we need to refresh this folder at least once a week. And the only way that I see it sensible to do so is after the trading week is concluded. So between Saturday morning and Saturday evening, it'll be my responsibility that I will hold on to make sure that we send an email out to let you know where our new folder is going to be pointed to. In addition to that, we're going to run us off a safety folder just in case we get interrupted and some corruption happens during the course of the week. We can still communicate to each other by way of the safety folder. So long as that you guys accept that link, it'll just be another notification. And I just consider it as a fail-safe in the event that our communication gets interrupted coming from me. Is that fair enough?
That's fair.
Perfect.
Absolutely.
Absolutely.
Perfect.
Yes,
perfect. I'm all about retention, guys, and redundancy. So anything that we can implement to try to get in there and create another layer of redundancy, I'm all for that. Now we're going to go ahead on and we're going to talk about our Fibonacci levels. And I'm well aware that you guys are knee deep in the Fibonacci levels by way of Mr. Burry's course. But I wanted to bring this to the forefront because it's indicative to the style that we trade with this 1, 2, 3 strategy. We're not going to waste a lot of your time on the Fibonacci levels because the majority of you guys are very familiar and proficient with these levels. So we'll just jump right into it at the 618 and the 786 levels as they relate to the way that we trade these 1, 2, 3 strategies. This chart right here can everybody see this okay?
Yes.
Okay, perfect.
Yes, sir.
We just pulled this chart just right out of the air, just so you guys know. This is a Euro-US chart of last week. It's a 2-hour time frame, but what I'm about to show you guys works on any time frame, a monthly chart, a daily chart, a weekly chart, a 2-hour, a 15-minute, a 1-minute chart. It doesn't matter. It works on all of them. I just wanted you guys to understand the risk to reward ratio as it relates to the 618 and 786 levels as far as stops and AB boundaries and things of that fashion. So on this particular chart right here, these are the Fibonacci's, and they're coming off the lowest low, which is right here, and the highest high. And we're concentrating on this 618 level down here. It pulled back down. It came down deeper than the 382. It came down deeper than the 50 and came down here to the 618 level. So when you guys see me putting 618, 786, that's what I'm looking for. I'm looking to get this guy right here in this area at 618. That's this red line right here at 1.540. And this is just a random number because we're using this for a demonstration purpose because this Fibonacci level comes up all the time. So we came in here and we're looking at this thing at the 618 level. We're going to get 10 pips in front of this level to ensure we get filled before this thing decides to turn around and run the other way. That 618 level is going to take us to this D extension right here. So we got filled at this 618 level at the D extension. We got kicked out of that trade because that's where we decided to limit out. Now there's another straddle strategy that you can put on top of that D extension to put yourself another open entry order here right above that D extension in the event that it does what this chart suggested it does. And then you create yourself another AB boundary with another Fibonacci level and run it up again. But for the sake of what we're talking about today with the risk reward, we're going to concentrate on the first A, B swing, which is down here. This A boundary, B boundary came down here to the C and bounced and went to the D extension right here at the 1618. That's all we're looking at to explain what the risk to reward is about. Limited in at 618 versus entering on a 1, 2, 3. I'm going to show you what the difference is and why it's so important that I wait for candlestick formations versus limited in on a 618. Here's what this is all about. If you limit in on a 618, you have to put your stop down below the lowest formation down here at the AB boundary, down here at 1.2510. That's a substantial amount of risk on a pair that's volatile. For instance, the Euro GBP or the GBP New Zealand that moves 250, 280 pips every single day. This boundary for your stop can be as high as 250, 300 pips, and I'm just not willing to take that risk. But if you did take this risk, you're safe unless your trade completely reverses and goes the other way. And that's another conversation that we'll talk about later on about trend direction, monitoring on a larger time frame to ensure that you're in the correct trend, uptrend or downtrend. So if this is your risk right here at 618, you're placing your stop below the A. This is your entry right here at 618, and your projected limit is up here at the 1618. This is what this trade looks like to me, the risk versus reward. Here's your risk, and this is what your reward looks like. And that's a 3-to-1 ratio right there. You're risking 1 for 3. So if we got stopped out right here on this 618, I'd come right back and grab it at the 786 if it decided to pull back down that deep. And now our risk to reward would look very similar. It would just be 3.5 to 1 versus 3 to 1. Everybody tracking that so far?
Yeah, that makes sense.
Okay.
Yes, sir.
Yep.
Now, that right here, this 3-to-1 reward ratio, this is limiting in at a 618. You can do that. It's okay for us to take that trade providing we're on the right direction, because sometimes trades get in there and they start to bounce around. If your A or if your stop is below this A, you should be safe unless the trade turned around and went south. So you don't want to limit in at a 618 right in front of a fundamental announcement. That's a foul, because who knows what that fundamental announcement is going to say. It may beat estimates, it may surprise estimates, it may come in below estimates, which can cause this chart to rock, and your candlesticks is way down here now. And you've already taken on that 200 pip risk in less than 5 minutes. And it's just not appropriate to do that if you're talking about limiting in on a 618 on normal trading environments. But you take that concept of limiting in on a 618 and put that right next to what I'm about to show you now with the candlestick formations. Here sits a bullish shooting star. Right there, this little orange arrow, that's a bullish shooting star right there. And it happened to be right at the 618 level. So instead of us taking a 200 pip stop to get down here below the A, we can just trade this candlestick formation. And what that risk to reward is going to look like is this. Here's your risk because you put your stop 10 pips below this candlestick formation. So if this candlestick formation that's 35 pips tall, you have 45 pips at risk instead of 280 way down here. This 45 pip risk is what you see me take every single day. I trade candlestick formations at these levels, at 618s, at 786s, and at 860s, because it saves you from the stress of having to take a 250 pip risk when you can trade this candlestick formation provided it shows up. If this candlestick formation shows up, this bullish shooting star, this trade went on ahead and got. Here's the risk to reward ratio. And I say that all the time when I talk to the charts. Go on and get. My wife, she laughs at me every time. Here's your risk right here, guys. This red box right here is your risk, right at the 618. And instead of it being deep down here by your AB boundary, It's just 10 pips south of the candlestick formations, which is this bullet shooting star sitting right next to a Pearson line. Here's your risk and here's your reward going from the same 618 back up to this 1618 extension. That's way more than a 1 to 3. We get stopped out a lot on this because this candlestick formation, if this candlestick formation right here fails, it's going to go down to the 786. Even if that's the case, we've risked 2. So we see that same candlestick formation form right here at 786. I'm taking it again. If it comes down again to the 860, I'm taking it again. Now, if it gets down here to the A extension, now we have to go back to our larger time frames and find out what happened to make this thing retrace so deep 100%. That's something that you address when you get to the 860 level, because a lot of times at the 618, it will come down and test past support to become future resistance at the 786 level. But this is what it looks like on a risk to reward ratio. On your risk to reward ratio, if you take this candlestick formation at the 618, there's your risk, there's your reward once, twice, 3, 4, 5, 6 times on the same exact setup. Instead of taking it from the 618 to the A extension, you take it from the 618 to the bottom of the candlestick formations minus 10 pips or 10% the daily trading range. Make sense?
Yes, sir.
Yeah.
What time frame was that chart on again, X?
It works on any time frame, on any time, sir.
Okay.
It doesn't matter. Now, I happen to trade on 2-hour time frames because I need the luxury of being able to flip through 20 charts every single day and have 2 hours to do it. So you'll notice how I'll start to trade at 9 o'clock and then I'll come back and take a look at it at 12 o'clock, or excuse me, at 11 o'clock, because this entire candle was 2 hours. If I traded this on a 1-hour candle, I have to be concerned that this thing can come back and drop down below the 618 to the 786 in less than an hour. That's what the 2-hour provides us. Now, in this particular instance right here, when we got this thing at the 618, it took 2, 4, 6, 8, 10. That's 14. This is about a day and a half worth of activity for it to push all the way up to the 618. But if you consider how fast you would get stopped out, you get stopped out pretty doggone quick if this thing decided to blow up in our face and go south. As long as this thing is continuing to push up, we know by way of Fibonacci level, provided that we grabbed our lowest low, the proper lowest low, and reached up to the proper highest high, we have a high percentage chance of retracing back down to the 618 because the market moves in AB waves. It's going to go up, but it has to come back down in order for it to do so. So we are looking at grabbing this guy on its way up, back down here at this 618. And a lot of traders say, why would you decide to buy something on its way up? Well, that's with the understanding that it has to come back down to one of these retracement levels. It could be a super shallow 382 retracement, which I don't like to take. I don't like to take them at the super shallow retracements unless you have a monthly candle pushing down out of the stochastic and a daily candle pushing down out of the stochastic. That tells you that it's going to be a super shallow retracement. That's why the 382 level exists. So when you hit that 382 level, that's probably where it's going to bounce. But given the fact that you're trading candlestick formations, not exclusively Fibonacci levels, you would have to put your stop way down here if you traded the 382. I have no interest in doing that. Now, I'll trade a candlestick formation at the 382, and you guys will see me put that in there. We're trading at the 382 level, and that's a signal that, hey, this is kind of risky. This is a long way down. Now, if we're going to take this stop right here at 25, 35 pips right here to pick up the reward from the 618, it just makes better financial equity management to wait for it to get down here to the 618. If this thing bounces at the 382 and takes off and leaves us behind because we have a pending order at the 618, let it go. We'll catch the next one. We don't have to get every last one of them. We just have to make sure that we don't get stopped out of every last one of them.
Right.
That was my intent, to show you guys exactly how this stuff looks on chart, so it's not so demeaning on a Excel spreadsheet to say, well, this is the level right here. All right, why are we taking it here? probably because it's at a 618 or a 786. This 860 is the best level that you can get, but the stop is so tight, be it at an A extension or a candlestick formation, before it hits this AB boundary. And we've all been trading long enough to know that if it comes down here and hits this AB boundary down here, there's a high probability that it's going to keep on going down. It's a very high probability. In fact, if it touches this AB boundary down here, you can only take it to the top of the B. You can't take it way up here to the 168. So it's just not it's not a very good equity management tool to take them past the 860 level. If we get them there, that's great. Probably get stopped out 40% of the time, but instead of risking 200 pips, now you're down here risking 12 to 15. And that's just not a lot of space for a trade to move. So if it gets down here and you catch it on the way up, the reward is going to be phenomenal. Now, when we start talking about taking this 618, if we take this 618 right here and we get stopped out, and we take it down here at the 786, it's still going to be a 1, 2, 3, 4, 5, 6 risk to reward ratio. That's why we can take this thing 3 times on the same exact trade with the same exact setup and still put pips in our pocket at the end of the week. Now, the problem is if we take a stop right here at 618 and then we take a stop right here at 786 and we miss the 860 turnaround. There's the problem. But when we're talking about this strategy that lasts all week from Sunday to Friday, this is why we continually put pips in our pocket, because of this very ratio right here, the 1 to 6. When you can get these guys at the bottom of a candlestick formation, instead of taking this risk right here, I'll take that risk right there all day long. But you're buying this bullish shooting star. You have to wait for this shooting star to close to buy the next candle, because this thing can come down here and test that candle, and then you'll get stopped out on the test. So when you see this candlestick formation right here form, and I'm communicating to you guys, hey man, we're taking this Euro US at the 618 level up to the D extension. This is exactly what I see. This is why we're taking a 40 pip stop, because there's 320 pips to go. Now, will it get there in one day? Probably not. It'll probably take 2.5 days, maybe 3, depending on what the daily trading range is for that applicable pair. But I wanted you guys to have a visual component to what we're doing on paper, so it can kind of mesh and sit a little bit better with you when you say, man, we just took a 45 pip stop. Yeah, we did. Now down here, we're going to wait. We're going to wait for it to get to the 786 level. And then we're going to take that same stop if this same candlestick formation shows up. Because as long as this thing is in the up push zone and the daily stochastic is pushing up and a monthly candle is pushing up, there's a very high probability that there's a lot of pressure to push this thing north. And if we're identifying the trend correctly, we have all kinds of opportunity to take this trade at multiple levels. I'm not interested in at the 5-0, and I'm not interested in the 382 on a day-to-day basis. The stars have to perfectly align for you to take something at the 382, because you very rarely see a king's crown or a reversal pattern with the candlestick formations at a 382 level. They usually appear at the 618 level by way of this example right here. What you got, fellas? What kind of questions you got?
Well, that makes sense, Doc. I see it. Anybody?
I mean, give it to me. Whatever you got.
Hey, Mr. Hatch, I have a question. You know, you were saying that as long as you come in at the right level, at the right lower low, okay, and I see where you came in at the lower low, but how did you know to come in and start your Fibonacci pattern at that level, at that lower low?
Because when we saw this thing down here, that's an excellent question. My goodness, that's an excellent question. When we saw this thing start to turn around right here at this 1.5247, we as traders get excited and say this thing's getting ready to go north. But where do we get in? We don't know yet, because at this point, when it first turned around, there's no high. Here's a higher high right there. There's a higher high right there. There's the next higher high right there. The last one is there, and this is the final highest high. This just happens to be where I pulled the Fibonacci's across. So if you're looking at this thing at 2 o'clock and your activity is right here on this red candle after that highest high, you're saying to yourself, okay, well, where do I get in? That's where you draw your Fibonacci's from the lowest low to the most recent highest high. And then you let Mr. Fibonacci and all his infinite wisdom tell us where the next level of support and resistance is going to be. Because if you look at this 618 right here and you look 30 candles to the left, there's a whole lot. There's resistance there. There's resistance there. There's somewhat of some resistance there. There's even some resistance right here. So this 618 is true. So if we saw this candle right there, this red candle, and we're looking at it saying, okay, this thing is going down, it's not continuing to go up, that's not necessarily true. Our Fibonacci's are going to tell us that right around this area right here is where we're going to see our best equity management entry. Now, in your defense, sir, we could have taken this candle we could have pulled our Fibonacci's there. They would have been very similar to the 618. This level and that level would not have changed that 618 very much, maybe 2 or 3 pips at best. And you can pull your Fibonacci going up or going down, but you have to get the lowest low right. Just because this candle is low right here, this one right here doesn't make it the lowest low, because this candle, the 2 candles to the right, is lower than this candle. So this actually is not the lowest low. That's why you have to wait. If you were looking at this candle right here, you have to wait for it. You have to wait until you get all of this price activity before you see a true lowest low. Because if you would have estimated or guesstimated that this candle right here was the lowest low, this one would have took out your lowest low and it wouldn't have been accurate. A lot of times you see me on the sheet say, well, we're waiting for the other side of this Fibonacci to show up so we can find out where to get in it. Because right now we don't know. This thing can just keep on going. And if it kept on going, we got to let it go. Because if we don't have a defined, proven, rock solid format to get in it, we just can't arbitrarily jump in a trade because it's going north. You and I both know when we do that, that thing always turns around. I'm not, woman. Excellent question, sir. Any other questions on the subject?
I'm good.
You good?
X, can you hear me?
I can hear you loud and clear, sir.
Awesome. Good morning, fellas and everybody. I was talking to Curtis in regards to like announcements, and obviously we all want to be able to catch as much of that movement as it comes, because we obviously see announcements cause the pippage to just increase, shoot up or shoot down. And one of the theories or the questions that I had, just kind of thinking, is it possible for us to create somewhere around the announcement, like 2 separate orders on a pair, one going north, one going south, with some stop losses like set for both orders. That way, if we catch it going one way, one of the orders catch, or if it goes in a different direction, then the other order catches it. Like, is there some sort of strategy like that built around those announcements, knowing that we don't really know which direction that announcement might take a pair?
Absolutely. And to answer your question, I've been trading that type of strategy for a very long time, and what we call it's a wedge strategy. It's no more than a stock option strategy called an iron butterfly. That's all it is an iron butterfly laying over a double diagonal position. So all we're doing to answer your question and reduce it to very, very simple terms to answer that question, yes, you can wedge that trade. You can put a pending order entry in right here, and then set you a pending order entry in right here, and that way it doesn't matter which way it goes. The problem is applying that strategy to the right announcement. Now, digital announcements are the way that you want to apply that strategy. And the way that that strategy works, sir, is you want to get 50 pips away from current market activity right before the announcement. Reason being is because if you look at your charts around a fundamental announcement like non-farm payrolls that comes the first Friday of every month, what you'll see is these pairs will fall into consolidation 15 minutes before the announcement is made, and then it will blow north or it will blow south. Now, you've seen me in the commentary box of Dropbox tell you guys before we go into this public announcement to be careful of the whip, because a lot of time the speculation of the direction of the trade will force it to go arbitrarily or inadvertently the opposite direction. And you'll think that your trade is going north, you'll close your southbound order entry, and it will take you on a ride north. That's why you want to get 50 pips away from it. And it's just rule of thumb. Because when you look at that consolidation on a 15-minute chart, you'll see that we're consolidating within a 12 to 15 pip range. 50 pips is plenty. So if you get 50 pips north of current price activity and 50 pips south of current price activity, the whip, you should be able to sustain the whip. And then once it decides to go whichever way it's going to go, it will take you. That's on a digital announcement because all the traders see the same information at the same time. That's totally different from trading a testimony. When somebody's testifying or somebody's making a speech, us as traders react to that information throughout the course of the speech. And that's not a good position to put a wedge trade on because you can get filled on both sides and now you're hanging on inside that box.
Gotcha.
You are literally bouncing around inside that box and it's painful to do that.
Yeah.
So what we can do for that, what we can do, we can write that down as something that you guys, we can show you guys how I've traded it. Not to say that this is the best way, but to just provide some clarity on a way. Not the best, but just a way. Mr. Johnson and I have been involved with a couple of vertical trades that were public announcements, and sometimes we get a 500, 600 pip move out of one particular chart. The Euro Australian surrounding the non-farm payrolls is a big one. And the other trick to that particular strategy is knowing which pair to look at. Because a non-farm payrolls affects the Euro US different than it affects the GBP Jappy. The GBP Jappy might not move at all, but the Euro US went up 500 pips or down 500 pips for that matter. So that's part of the strategy too, to do a little bit of research on understanding what announcement affects what country if the announcement surprises or if the announcement disappoints. That's also in the book. We can get you that information too.
Awesome.
So we'll write that down,
and then
and we'll talk about that a little bit more in depth on the next one. How about that?
Hey, sounds beautiful.
Perfect. Funny.
And then if anybody else didn't have anything, I wanted to just discuss being in those trades from last week, still unable to close them out, and what we're looking at for the week moving forward.
Look at those trades early this morning, and by way of the daily candle and the monthly candle, we're going to be trading in that same direction this week anyway. So I think that you'll be fine. Now, what you will find is that the market likes to gap at 5 o'clock. Last week, it gapped on us at 7. That's how I got caught in those gaps last week by way of the late gap. Now, this morning, I got information saying that a plane over Russia went down. They didn't say it was shot down. They just said that it went down. It's stuff like that that worries me over the weekend. Now, swing traders, they can absorb that all day long. But if you notice, we're in and out of positions 1 or 2, 3 days. We're not holding them very long. So we're not really interested in the overall movement for a chart for 3 to 4 weeks. We're in it for right now. If we're going to get stopped out, stop me out right now. I don't want to get stopped out on Friday. I want to get stopped out right now so we can get this chart off the P&L and go to the next one. Now, your swing trader, that's going to affect that particular individual trader differently because they have more time to let this thing fall down 200 pips and then recover. It's my position to, if this thing is going to fall down 200 pips, I want to grab them 200 pips on the way down. I don't want to give those 200 pips back to the market because we're in a long-term trade. That's not what this particular strategy is. There's another strategy for that for swing traders. It's just I don't exercise it because my job is to put pips on the sheet that you guys can grab too. So I don't have a lot of room to give up a 300 pip stop because of something that happened over the weekend. But for your trades, the Australian Jappy, the US Australian, and the Euro US, I think that you'll be fine. But I want to look at them as soon as the market opens to consider which way the gap is going to go, if it gaps at all, because it very well may gap in your favor. We don't know. But I think that overall, I don't think that you're going to wake up or open the market on Sunday and be 400 pips in the negative or completely stopped out of all four of your trades. That's not going to happen. I don't see that happen. You'll be fine.
Cool. Awesome. Thanks.
Yes, sir. Yes, sir. Anybody else have any questions?
No questions, a request, X, at some point in time, and probably not on this seminar. If you can do a how-to on your active chart on the side buttons and how to best use those to chart ABCDs and your longs, and it's got a lot of bells and whistles on here. I just want to be able to blow them and ring them.
Okay, I tell you what. How about we get together and we talk about that next week?
Wonderful.
And guys, it's Curtis and I. We had this conversation early last week, and I said I would like to get together with these guys and spend about an hour. I don't want to eat up too much of your Saturday morning, but if we can get together for an hour just to go over some things that we saw that may be some potential learning curves for you, something to the tune of why we're trading a 1, 2, 3 at a 6, 1, 8 level. That's because we got a stochastic coming up. We got a candlestick formation right here. We've got 40 pips to risk. I'll put this trade on and I'll go cut the grass. I'm done with this trade. Because if it gets stopped out, guess what? I got an alarm down here for 786, and I'll come back in here and I'll put that same trade on because we've identified the trend. You guys can see the trend from here on this particular chart. There's right there is your outer trend line, and then from this candlestick right here to that candlestick right there is your inner trend line, and from this candlestick to this candlestick is your aggressive trend line. As long as it doesn't pierce that thing, it's not coming back. We just have to find a suitable and a financially sound, a financially smart entry into this thing. That's why we use these 618s. So Curtis and I got together and said, hey, man, why don't we just get together for an hour or so on Saturday morning and let's look at some of this stuff. And I'll try my very best to give you guys informed content and not ramble, and make sure that we have a detailed layout on what we're going to cover and why we're going to cover it, because it applies to what we do every single day. That's my obligation to this agreement.
I like that. I have one question.
Yes, sir.
As well.
Yes, sir.
You know, on Wednesday, we had gotten I think about 6 or 7 trades, and that thing, earned us like 600 pips.
Yes, sir.
Like for myself, I did not get an alert in time enough to get into those trades. Is there any way where we can get like a signal when the chart gets updated for us to go into these trades?
Absolutely, and that's an outstanding question. What we found out, that our sheet this week, somewhere in between the Dropbox integration and the way that I'm using it with Excel, my sheet was auto saved.
Okay.
And I'm not a real familiar guy with Excel because I operate in the Mac environment, but the way that Excel auto saved to do the update, the weekly update for Office Online, it auto saved my document and came back up and had the same file name, just had an auto saved on it. So I'm communicating to you guys on a sheet that doesn't even exist. That's what the problem was on Wednesday.
Okay.
But to add to that, I took that particular scenario and then came up with the reason why we're going to go to this little security folder. Because what I've noticed about you guys is when you guys see something, you guys say something. I've noticed that about trading with you guys, and I appreciate everything and every single comment that you guys put in that box, because it lets me know, if nothing less, that information is outbound and it's being received. So when I put that commentary in there and I didn't hear anything from anybody, it led me to believe that maybe something was wrong. I just didn't know what was wrong. So if that happens, we're not going to have enough time in the course of a daily trading day to try to recover. That's why I wanted to implement this safety folder right here. So if you guys can accept that link when we send that thing out, that means that we'll have a secondary form to be able to communicate to you guys in the event our blue group file was deleted, was corrupted, was otherwise removed. Now we have nothing to communicate to ourselves, because what we have in place at the website right now is waiting on our own version of Dropbox that we're building. So for the time being, we are subject to the delivery components of Dropbox. While they are efficient, they are data, and data can be corrupted. So that's why I wanted to go to the safety folder to help us help each other, to make sure that we still have communication no matter what happens to this sheet. We have another one sitting right there on safety pilot, just in case this one right here turns south. Does that kind of satisfy what we're wanting to do?
Okay, let me ask you a question. If it goes into safety folder, will we then know that we got data in safety folder so that we can react to that information?
Absolutely. Absolutely.
Perfect.
The moment that I find out that something's wrong with Blue Group or this blue sheet, we will automatically call an audible and go directly to safety folder. No
Perfect.
stops, no collect, no, we're going straight to safety folder. Because like you said, it wasn't enough time. Curtis asked me to send out a global communication from the website by way of text message to inform our traders, hey man, the sheet is updated and it's live. Those trades were active, but every single one of them was either at or around the entry level, because we put those trades on for the GBP claimant count that morning at 4 o'clock, and for the New Zealand information that came out later on that afternoon. That's why we took those positions, to get out in front of them. So if they do go our way, we're going to grab a whole bunch of cash on the way. And if it doesn't, we get stopped out with minimal loss. So in that particular scenario, it does warrant a conversation about what are we going to do if something gets taken offline. And the best thing that I can come up with in a relatively simplified fashion to satisfy all moving parts is to just have a redundant folder that's we've already accepted the links, so we don't have to filter through our mailbox and say, well, I got to find the email and I got to accept the link and then we have to send out the notifications. No, we're going to do that on Sunday night. The same way that we sound off to each other on that blue sheet, we will quietly sound off to each other on that safety sheet, just to make sure that everybody's tracking that sheet, just in case this thing goes down. I don't see that happening no time soon, but in the event that it does, the last thing that I want to do is leave 600 pips behind because we collectively couldn't grab it. That's no dice. I don't like that subject. Not at all.
That'll do it. That'll work. Works for us.
That's a 10-4. I mean, as these things come up, until we get our own server right here at 1805, I have to figure out on the fly how we fix this stuff. And like I said earlier, when you guys are communicating, that lets me know that our information is outbound and it's being received. So when I put information on there, for instance, on Thursday, I put a daily recap of why we took the Australian Jappy and why we took the Euro US and why we took the Euro Australia. And I heard nothing from our agents. And that led me to worry. That was the first red flag that something was wrong. So when I didn't hear
Hey,
anything back from the agents that are watching this stuff religiously, I said, well, maybe we need to create something, a layer of redundancy, just a safety net, a fail safe, because I can inadvertently delete it. Anything can happen, and I don't want that to happen because we don't have a formidable way to get commentary between ourselves. It's not about the alerts going out. It's about the commentary that comes back, because that's how we all know that everybody's tracking and everybody's on the
right.
same sheet of music, be it blue or otherwise a safety folder. So I think it'll work, and we'll give that a shot Sunday. Matter of fact, I'll send the links out this afternoon. Uh, you guys have done this enough to where we know that we send a link out to invite you to a particular folder. It's going to be the same process when we send it out for the safety folder. It's just we will have that safety folder already in place, ready to go on day one, instead of waiting for something to fall apart on Wednesday and now we have to recover. Let's recover on Sunday before something happens so we don't have to recover on Wednesday when something does.
Hey, Xavier.
Yes, sir.
Hey, I kind of noticed that something was going awry when we didn't get an update on you from the British pound USD, because it had moved. It crossed the 100 pip mark, then it crossed the 150 pip mark, then it went up 200 pips, and we still hadn't heard any advice as far as closing it or changing stop losses. That was my first indication that something may be wrong. But in the future, even if we miss a trade, the entry because we're at work or because we're otherwise occupied, what's your advice on getting in the trade after it's already moved 20, 30 pips or so? If we get in that trade, should we adjust our stop loss potentially, 10, 15, 20 pips below or above where you have it because of the risk of it, taking more potential loss on the retrace because of the entry point?
Well, that's an awesome question. If we look at this particular candle, right, let's see, 1, 2, 3, 4, 5 candles after we entered this trade right here at 618, and it started to run. What I do is I draw a aggressive counter trend line right up against the right up against the side of this candle right here. And when it breaks that trend line, there's your entry right there. That was your entry right there. If you can visualize a trend line coming down across the bottom right and the bottom right of this aggressive candle, there's your entry. But you have to place your stop below this candle. Your stop has to be right there.
See, that's the thing, because if we're at work or X1, different places, that's why I was hesitant to get in the trades. They actually, when they came back up, like you say, they weren't too far from the entry point when it actually came up, and a couple of us were kind of hesitating whether or not we were going to get in. But 30 minutes after it came up, a couple of the pairs were already close to 100 pips up, and then I think I made the decision not to get in. Maybe a couple others made the decision not to get in at that point because we weren't really sure if the train had already left the station. And then I couldn't look at any charts to do what you just did as far
I see. Yes. That makes good sense. Yes. Okay. Yeah, and a lot of times when we catch them, and you guys hear me talk about trading the post-announcement directional trade. And that's what you'll have. For instance, if this candle right here was a fundamental announcement, which looks like it was, this candle right here, I wouldn't trade this going down immediately. I wait for the next couple of candles and then trade the direction, because you see what happened after it broke out of its normal daily trading range right there? It continued to run. That's a way to trade multiple announce or currency pairs across an announcement. Because, for instance, when Yellen got on the microphone on Thursday, she affected every single major cross that exists that we trade. So you can basically just go in there and hand pick one and wait for the momentum to show you which way it's going to go and just trade it down or trade it up. But where you place your stop is a significant component to trade in that style. We call them fundamental breakouts. It's a phenomenal way to trade, but you have to understand where your stop has to be in relationship to having no limit. You don't put a limit down here because on a fundamental announcement, once it breaks out, if you put your limit right here, 100 pips away from your current activity, you just basically cut yourself off from another 250 pips, and it hurts when we do that. So you want to not put a limit on it, but that can be something else that we talk about on how to trade a fundamental announcement that's already broken out. One of the questions that came up earlier is how we get in front of the fundamentals before they break out, but there's also another way that we can show you guys how to trade a fundamental after it comes out. That's the way that I do it all the time. We did on Wednesday, we got up for the GBP claimant count at 4:30, and we got our positions on at about 3 o'clock to get in front of that. And those positions held fast because the claimant count didn't do anything. So we stayed in the Euro New Zealand and we stayed in the Euro Australian. And then when the GBP, when the information died down and it was time to roll into the New Zealand fundamental announcement, we were already in position. So we just adjusted our stops real tight, real close to break even, or real close to the highest high or the lowest low of the previous candle to the left, and just let them take off. And that was phenomenal risk to reward ratio. So what we can do is show you how to do that, and then make sure that we are communicating throughout the course of the day about the fundamental announcements that we put on our blog post to inform you guys on what's coming. Because if we know what's coming and what it's going to do, we're 60% ahead of the game. Not knowing when a fundamental announcement is coming is how we get bit.
Appreciate it. Makes a lot of sense.
Perfect. Anybody else have any questions? We're pushing up about almost an hour now. Anybody else have a question?
No, sir.
All right. I mean, if there's anything, guys, we're here. We're all in this thing together, man.
Hey,
Yes, sir.
hey, can you hear me?
I can hear you loud.
Hey, this is Jarvis.
Yes, sir.
All right, quick question here. I come from a background of application development and monitoring systems and so forth, and was wondering, what are your plans as far as automating some of the processes here, as far as alerts and so forth?
Well, we're going to start to deal with the alarm information that is inside or embedded into my signals that I have, and reroute that back through the website. Because here's the problem that I have. If we have an alarm set up for a particular basket, let's say the Jappy basket, and this alarm triggers, and I won't take the basket unless it has 4 or more of the 6 pair. If we have 4, I'll take it. If it has 5, I'll take it. If we have 6, I'm all over it. But sometimes a partial basket shows up and you have 3 of the pairs. Now there's alarms set counter trend line wise and moving average wise that when those alarms are triggered, because they're crossing those trend lines, suggesting an immediate breakout. What we're going to do, and we're working on this as we speak, we're going to take those alarms and change the code for it to come to me to reroute it backside to the terminal of the website and send them out. That way, if you get an alarm for a 3-tier basket and you want to wake up at 2 o'clock and take it, no problem. It just won't be reflected on the sheet if I didn't take it. I just don't find it appropriate that we're only taking trades that I see, because there's sometimes that I won't get up at 1 o'clock because it's only 2 of the 3 of the basket. I'm not interested in that, but you very well may be. So we're just going to reroute that code back to the website, because the internet does not sleep. I have to sleep at some point, but the internet doesn't. So we're going to let the internet handle the heavy lifting to where it takes that information and processes it inbound, in-house, and pushes it out.
Okay. Sounds good.
I thought you were on no-dos, X.
Well, I ran out last week, brother. I ran out. You know, I don't get out too much, so Shantae, she keeps me kind of locked up in this office here. I don't get out too much. She said, you can't go nowhere till you get 800 pips. I said, all right, maybe I can get outside today. A lot of fun, man. A lot of fun. Yeah, sure. That's something that we're working on. It's quietly been taking shape. It's quietly been formed, but once we finish it, and we're probably going to start pilot testing that as early as late this week, maybe even early next week, but I anticipate it'll be ready by mid-April. How you were
Well,
privy to
I
such
think I think
information is mysteriously questionable.
well, I think that'll work. That'll work well for,
Good.
particularly for me. I can speak for me, and maybe for some of the other brothers and sisters that might be working, punching that clock, because I'm up, 4 or 5 o'clock in the morning anyway. So another hour or so earlier to take an alert won't hurt me. If
What
I
time
could
zone
get
are
in
you on, sir?
Central
Central time.
Central
Okay, so
time.
when I get up at
So
4 o'clock, you're already up.
right, I'm already up. And but because my thing and what I do is try to get into something before I go to work and get out by the time I get to work, and that tends to work best for me. And then Asian market, London market opening up or closing, as long as I'm reasonably sure that I can get into a trade, without getting fired from my job at the same time, works for me.
How long does it take you to get to work, Mr. Blue?
Depending on traffic here, it could take anywhere from 25 minutes to 45 minutes, depending on traffic.
So are you interested in really, really short-term trades, 45 minutes or less? Do I understand that right?
Yeah, absolutely. If I could get into those trades, on drive time, and by the time I get to work, I'd have made 30, 40 pips and get out and go to work and not have to worry about it. I'd be great.
Well, I tell you what, that that is something that we can look at as early as next week, and the reason being is because at the London Open at 2 a.m. Eastern time, which is just slightly earlier on your side, but a lot of stuff happens at the first wave of that bell curve between 4 and 5 o'clock per se. There's a strategy that we look at when we're up that early in the morning. It's called the pound reversals. If you guys look at your pound pairs close enough, you will see that the pound reversals happen at 5 a.m., 8 a.m., and 11 a.m. every single day because the pound pairs have to correct themselves every 24 hours.
That's 5, 8, and 11, you said?
5, 8, and 11. Every single, like clockwork. Now, sometimes they won't turn around at 5, 8, and 11. They'll keep going. But that's the concentration window. You want to look at them at 5, you want to look at them at 8, and then you want to look at them again at 11. After that, I'm pretty much done with the pound pairs. It's been probably a month since I've done that strategy because we're concentrating on 2-hour candles after the 9 o'clock set or after the New York session. But that's still a strategy that you can implement if you're talking about that time of morning. Now, if it's the consensus, the guys are in short-term trades for 20, 30, 40 pips for an hour and a half or less of time, we can shift a little bit of our concentration on that because we're already up. We're waiting on the bell curve to complete. We can implement the T40, the 2040 strategy, the T3 Tilson, anything like that to get us 40, 20, 30 pips in an hour and a half. I mean, if that's what you guys are, are looking at, we can look at that too. It's no big deal.
Yeah, I think a lot of guys will be really, even myself, man. Just those of us that's getting back to even my networking side and them 40. That's I think that's, I can speak for myself, man. That'll be huge to be able to just lock in some pips early morning, and then go ahead and do what you got to do throughout the rest of the day.
Sure, but I mean, the 25 and the 30 and the 40 pip, that move it's kind of predictable to find that kind of move, especially at that time of morning. But what I concentrate on is the 200 pip moves. That's where a lot of my efforts go into, is finding ourselves the 150, the 250, the 300 pip moves that are going to take us a day and a half to fulfill because we're risking 40 pips.
Yeah, we don't want to lose that one either, Mr. X.
Oh, absolutely. By no means do we want to lose that.
Okay, fair enough. I mean, the more time we spend with each other, guys, I'm trying to get a personal feel for what direction we're going to go in, because that strategy right there, the one that I've been working with for a very long time, this 1, 2, 3 strategy, it's designed for Fibonacci fulfillment. That's what it's built for. And with that said, we're going to take a 50, a 40, a 60 pip stop all the time. The only time you're going to see us take a 90 pip stop like we did Sunday morning is when we're dealing with those heavy hitters that are moving 300 pips a day. We have to get out of the way. We have to. We have to get out of that guy's way because he moves so fast and gets so violent. But when he starts to take off and run, I think the Euro US did that late Friday afternoon on a correction day. I mean, that's just how those pairs work. But if we can get kind of mesh ourselves around what it is that we're trying to accomplish from the market, we can start to cater and rebuild or even implement a strategy that will satisfy that. Because getting 40 or 50 pips in a couple hours time, that's I think that's pretty doable. Not too bad.
Okay.
I think that's pretty doable. I think we can do that.
Hey, X, this is Jarvis again.
Mr. Jarvis, go.
Yeah, Curtis and I was having a discussion about confidence levels in your trading strategies.
Yes.
Well, in your pairs, do you have something in place currently that that's on the chart that we may be overlooking or may not be knowledgeable of that explains, hey, with this trade, my confidence level is a high, medium, low, and we were discussing that because that kind of may give us an indication of what type of lot size we may want to push for with, determining your confidence in what you see in those pairs and how it may move.
Mr. Jarvis, to be frankly honest with you, I trust every single one of them. And that's only because I have no emotion tied to the trade. I have absolutely no emotion tied to the trade, so much so that sometimes I put the trade on and I won't see it until later on in the next day. Now, it's not to say that I'm less confident about a particular trade, because that's not necessarily true. I can tell you what does give me a great deal of confidence is when all of our stochastics are going the same way. When I see that kind of trade, as a matter of fact, I wrote down on this paper to show you guys one day this week, the Euro US, as I wrote it down, was a textbook trade because you had a monthly candle pushing down, a weekly candle pushing down, a daily candle pushing down, and a 2-hour candle pushing down, and a candlestick formation at all 4 of their chart. There's nothing that, I mean, God just handed us that trade. Said, here you go, man. This is for you for being disciplined, for being a good boy, for loving your wife. I'm going to give you all these candlestick formations and all these stochastics going the right way. I suggest you trade. That was how it felt to me, which sometimes we don't get all of them going in the same direction. Sometimes you have opposition and conflict across your stochastic pairs, but the stochastic by no means is the holy grail of all indicators. It's not. It's just a level of confirmation, but it's not designed to prevent you from executing. So if I think I understand what you're saying, right? Is there a way for me to identify a potential trade or a set of potential trades as highly probable or not? You're going to get your highest probability out of trading a basket because it's not just one pair. It is a collection of currencies that have the same cross that are doing the same thing at the same time. I put my biggest buck on a basket every single time because you have multiple currency crosses up under one umbrella currency. And if they're all going the same way, if they're all showing a candlestick formation and they're all at a Fibonacci level, I wouldn't bet the ranch on it, but at least the driveway.
X, let me ask you a question on
Go
that.
ahead, sir.
Why
I love this.
why you pulling up pavement and stuff? Let me ask you this. Now, the baskets generally, and then this is just a general question: do the baskets generally form at the London opening?
Yes, sir.
Or the New York? Okay, the London opening. So. Yes. So the alerts that you're talking about, the bells that will go off at 2 a.m. in the morning would be 1 o'clock my time. That would be where I could get up and look at the euro basket, the Jappy basket, whatever the basket may be, and make that decision at that point, as
Yes,
far as taking advantage of the baskets. And then this 20-40 strategy for the 50 pips in a day, you would then be able to, chart or update the chart concerning what might be a good pound turnaround, pound retracement trade for that drive time on the way to work.
yes, sir. And yes, sir. That I see where
Okay.
you're going with it. But this right here is what the baskets look like. And I use this particular terminal because it's available to everybody. If you take, let's see, how do we use this? Let me show you real quick. That ain't what we wanted to do. Sorry about that, guys. This wasn't part of my idea this morning. But if you look right here, here's your trend line right there. Okay, and here's your trend line right here. And this is a pound basket. And I'll just put some trend lines up here so you guys can see exactly what it is that I see. Yes, mine looks a little different, but the candles are all the same. There's your trend line there. This one didn't form. And here's your trend line here, right there. There's your trend line right there being broken. And this one is on the south side. And I'm going to explain to you why this one went down. Okay, you see right here, you've got the GBP Jappy in the top left. The GBP US didn't fit, so we wouldn't have took that one. The GBP New Zealand, the GBP CAD, and the GBP Australian. All of these currency pairs went up. The Euro GBP went down because the counter currency in relationship to the base currency. You got to know that. Because when you look at these things and you're getting these alerts and it says Euro GBP is crossing a trend line, you cannot buy this. You have to sell this one. If you're buying all of these when GBP is in the front and you get an alarm or you're looking at this particular basket on your own and you see this thing start to rally a little bit, you have to get short on it because GBP is the counter currency. It's impossible for the counter currency to go up with the base currency. It can't go that way. It has to go in the opposite direction. Does that make sense?
Gotcha.
Perfect. So with that being said, this is what I look at when I see a basket. We're crossing this counter trend line right now. It's go time. We're going right there. That's our entry. This one right here, cross that counter trend line. We're going. There's our entry. Same thing here. Same thing there. Same thing there. But what my position is if this one doesn't set up like this one didn't, and this one didn't set up, so now you have 3 baskets or 3 of the potential 6. That's really not interesting to me because I'm going after all of them. Because when you get all of them, you tend to see more relationship across the pairs. If you look at these pairs, with the exception of the Euro GBP, the GBP US, because it had that little pullback right there, now it's Janet Yellen. That's Janet Yellen right there. Right there is Janet Yellen. So
Okay.
when you look at these pairs right here, if you can identify the relationship and the similar patterns, even right now at the close of the market, they're all going the same way. That one's 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 going the same way. This right here is a fake out. These 4 right here can't be going the same way with the Euro GBP. That's what disqualifies this for the down basket. This one doesn't fit. So when you see this, you have to identify the fact that there's something happening in Europe that's making all of these crosses go the same way. And they happen everywhere. This is the this is the Jappy basket. There's really no setup, and it's hard to find them when you have a lot of announcements like you did last week. I'm sorry, go ahead, sir.
No, I was going to say, you say we have access to this chart setup?
Absolutely. This is called Trade Interceptor. And I have this actually up on a screen above these screens that we're looking at just to monitor a lot of different stuff really quick. And I pulled this up because I know that you guys can get your hands on it. It's called Trade Interceptor. It's really cool stuff, but you can pull up your basket And you see, those are the only 4 windows that we have, because that's all we care about on this particular piece of software is what our baskets are doing. Now, this right here is the US basket. And this US basket, God almighty, we missed this one. Holy smokes. Goodness gracious. Goodness gracious. If you look at this, guys, this right here, this trend line right there that was broken, that's Janet Yellen. But see, we were already in 2 of these trades. 2 of these trades are where we got a bulk of our pips from last week. There's another trend line right there. That's Janet Yellen. Here's another one. That's Janet Yellen right there. Now, if you look at them, all the U.S. pairs are the second one. That's because the dollar got weak. This is the U.S. dollar index right here. The dollar broke apart. As soon as you see this dollar fall down, all these guys, when the U.S. is the counter currency, it's getting ready to go on and get. This is the U.S. CAD right here. This is the only one that fell apart. The rest of them rallied because Janet Yellen is trying to weaken the dollar for global inflation. We know that. We just need to find out how weak she's going to make it. She decided to take 2 of the interest rate hikes off the table, and look what happened to your dollar. My gentleman, this is 1,900 pips right here in about 5.5 hours. It was bananas. But there was nothing that we could do about the ones that we were not in, because this candle was so tall. If you look at it, there is no higher high. The higher high is way up here. We had to let it go. But provided we'd have been in this basket in front of it and played this counter trend line right there, right there, right there, and right there, and right there, that's how you snatch 1,800 pips out of a basket without even looking at it. That's how it's done, guys. That's the secret to the sauce right there. I'm afraid we're going to have to edit this part of the video out. Sorry. we're going to have to delete this portion of the fellas, guys, because we can't get away with secret sauce.
You have to kill us, right? You have to kill us.
Yeah, we got. Man,
this message will self-destruct.
Y'all can give me some. But that's what it looks like, guys. And you have a Euro basket, or this is the GBP, and then you have a Euro basket, and then you have a New Zealand basket, then you have a US basket, and then you have a Jappy basket. And my suggestion is that you set them up as such in that relationship. That way you can look at them and you're looking at the same exact thing that I saw. There's a basket set up right there, but we didn't catch that. That was, who knows what that was. But if you look at these things like that, and you'll start to understand pattern recognition, and you start to take pattern recognition and overlay that with chart relationship. When you take both of those elements together, you have something very powerful and formidable that will help you execute these trade baskets with a little bit more confidence without just trusting what you see on the sheet. I understand that there's a very powerful element when you can see the charts also. This is you can use this on your phone. In fact, Mr. Johnson, Aaron, if you can get us a link and put this on the site for these guys, we can also provide that link for you too for a Macintosh and or a Android application. That way we can get it to you guys easier. But we use it every single day, and it's just a overview of what's going on your basket on a massive scale, so you can see all 6 of them at one time. It's awesome. Questions? I done put them to sleep.
Nah.
No, that's all good stuff, Mr. X. It's all good stuff. We just
I know you were asleep. I know you were asleep.
No. Hey, this is too much information to go to sleep on.
Good stuff, Mr. Brown. Good stuff. Good stuff. If you guys got any questions, I mean, we can rock them. Whatever. If you got time, I got time.
Hey, just so that everybody's I guess could be on the same page. So next week going forward for the duration of this time that we have with these baskets.
Baskets ain't gonna stop. Make no mistake about it. The baskets
I
ain't gonna
guess.
stop.
Yeah. Okay. Good stuff.
Yeah. Let's go ahead and put a nail in that now. While we're all here, I mean, we hold each other accountable and we depend on each other in different forms and different revs. But the fact of the matter that the baskets are going to be tradable all the time, I don't plan on stop trading. I hope you don't either.
No, not at all.
Let's get it.
Keep them coming. Keep
But
them coming.
what was the question, sir? I'm sorry, I didn't mean to cut you off. I just wanted to lay rest to that idea that we were going to stop trading baskets at some point in time. What is your question, Mr. Johnson?
No, last week, remember you mentioned that the I forget the name, counter basket. You mentioned just trying to get a timeline on what's the verbiage you use?
The
The
next
counter.
strategy coming up.
Yeah, there you go.
Yeah. Well, what happens, guys? As far as counter baskets are concerned, if you notice, this particular basket is going one way. There's sometimes you can have a relationship between the Jappy basket that's going south and the Euro basket that's going north. So instead of concentrating our efforts and capital on one basket, sometimes they set up to be in opposition of another. So now you've taken 6 baskets and now you're running, or now you're running 2 baskets, which is 12 pairs at the same time. You guys have seen us have 10, 12, 13 trades on at one time. I just much rather prefer they be in a basket. And the counter basket is what happens when there's some relationship, be it geopolitical or just currency devaluation or inflation information that comes out at the same time that causes the counter currency to go in the opposite direction. And the way that I can show you that is right here. You see how the CAD, the US CAD, was the only one that went down in this particular basket? That makes us go and look at the CAD basket because it's probably going the same way in a counter basket. That makes sense?
Right.
That's what that's about. Timeline wise, we don't know yet, but we know that we're working on it. Got destination unknown, brother Curtis. It's coming.
Well, the reason I say that is because with the retreat being next month, I think everybody's on the line is going to plan on being there. I know Deep flying in and a couple other guys flying in, so we can really kind of in a round table per se, lock up in a room and really what you're doing right now via webinar. We can really that's what the retreat was really designed for. For all of our traders and some of our networks coming together to really be able to implement these strategies, face to face and hand to hand. And some of these tools that you just mentioned, Trade Interceptor, and some of these little features that we have with the, I know we're gonna go over it next week on the website, but that'll be valuable for us to free up your time as well.
To bring the basket strategy to San Antonio.
Well, I mean, I know earlier on we was talking about I was gonna fly in there, and I know a couple of guys wanted to fly to to Maryland to sit down, but if we're going to be here all in one location, I think this is not for the masses, just for this group that's on the phone I'm talking about.
Yeah, sure. I got a basket carrying card in my right and left back pocket. I'm not going nowhere without it. Don't worry about that. That's it. We're all good. I'm certified. I'm vetted. We carry our basket cards in both pockets. So yeah, we can take that. That's no problem. No problem at all, brother. No problem. We can bring baskets to San Antonio. No problem. Matter of fact, I'd love to. Because the fact of the matter, guys, is at the end of the day, if the only thing I get out of this thing is knowing that you guys can identify this setup. If you look right here on the bottom right-hand screen, you see how the CAD fell into consolidation right before the breakout? If you would have drew a counter trend line right above the top of these candles, you would have never entered that trade because it never broke that trend line. You see that right here in the corner? If you draw a counter trend line going up against the bottom of these candles, you're getting in that trade because it's broken that trend line. It happens every single time. There's always an indicator to tell you that the basket is coming. It just happens so fast and at all crazy hours of the night. That's why we have alarms set on this trend line right here, and alarm set on this trend line right here. Sometimes, quite frankly, gentlemen, I just black out and miss it. Sometimes I just don't get it. Sometimes I leave my phone in my office. Sometimes mama says, you know what? Give me that phone. It's just a lot of components that can happen to prevent me from taking a basket. Now, last week, it's really difficult to size up baskets when there's multiple announcements going on every day. We've had 3 days last week with 2 to 3 major volatility announcements. So by the time the charts settle, something else is already coming. That's why we took a handful of trades instead of a handful of baskets, because the baskets won't make sense at that time. When things are calm, and you'll get those moves. This right here just happens to be a ridiculous amount of pips because we had Janet Yellen talk. So we look for 5, 6, 7, 800 pips per basket just based off normal trading activity, normal trading ranges. When you get this stuff and you're out in front of that basket on an announcement like that, my suggestion is get your spike strips out the street and just don't put a limit on it, because you have no idea how far it's going to go. Nobody does. Keep your stops tight and get your limits away from it. That's rule of thumb when you're in a basket going into an announcement. Write that down, guys. Keep that in your pocket. Take your spike strips out of the street. Move your limit. Because if you would have had your limit on this particular pair right here, the Australian US, set at 150 pips, you would have been kicking yourself later on in that afternoon to find out that that pair went 550 pips and you only got 150 out of it. We can all say, yeah, man, 150, that's cool, but not if we had a speed bump that we put in the street.
Gotcha.
Let's get them out of the street. So when you see these things set up, and we're referring to our information that we put on that blog post about the information or the fundamental announcements that we are concentrating on. There's 5 or 6 of them every week that we're focusing on, and we're trying to find ourselves a sensible position for that currency pair before the announcement. So we don't have to scramble, and we can just roll right into that announcement and not even care which way it goes, because we were in that position yesterday and already have gotten 25, 30 pips out of that trade. So we put our stop at break even or 10 pips before it. And if that thing takes off and goes airborne, so be it. If it decides that it wants to go for a nosedive, so be it. So long as that we're in the right direction and we're already in front of the announcement, it takes the anxiety and the panic away from trading a fundamental announcement beforehand. It's good stuff, guys.
Roger that.
Good stuff, man. Appreciate that.
All right. Anybody got anything else?
That's it, sir.